Monetary policy. Monetary policy is the process by which the monetary authority of a country controls the supply of money, often targeting a rate of interest for the purpose of promoting economic growth and stability, as defined by Wikipedia. Interest rates. Interest rates are one of the main tools used by the government to help control inflation rates. By controlling the inflation rates, you can control the CPI and GDP. If you are to adjust or change the rate of interest, money supply can be controlled. When interest rates are low, people are more likely to borrow money, which will stimulate the growth of the money supply. The opposite effect happens when interest rates are high. So using an example similar to the one in our unit, if you are trying to buy a house and you have $100,000 and you need to borrow the rest, the interest rate is at 6% for borrowing. That means you pay 6% of the money you borrowed each year. So if you borrowed another $200,000, then you would be paying $12,000 in interest per year. That means you have to pay back the money you originally borrowed, but the bank makes $12,000 in interest off you per year. Easy money. Easy money is defined as when the economy is recessing because of decreased employment, lower incomes, and less demand by consumers. The money supply shrinks as less lending is done by chartered banks. The Bank of Canada watches during recessionary periods for deflation and then implements an easy money policy, which basically decreases the rate of interest in order to stimulate the creation of money. Tight money is defined as when the economy is expanding because of increased employment, higher incomes, and more demand by consumers. The money supply grows as more lending is done by chartered banks. The Bank of Canada watches during expansionary periods for inflation and then implements a tight money policy, which basically increases in the rate of interest in order to slow down the creation of money. The Bank of Canada and Mark Carney. The Bank of Canada and Mark Carney held their interest rate at 1%. This hasn't changed since September of 2010. However, the Bank of Canada is hinting that there could be a rate hike in the future. These low rates have helped spur the Canadian economy. Another tool used by the Bank of Canada to help control money supply is the exchange rate. This is the current value of a country's currency compared to others. Canada has a floating exchange rate, which means that there is no set rate of change for our money. It is dependent upon the supply and demand for the Canadian dollar in an international market. In today's market, the Canadian dollar is very strong. Coming from personal experience, when I moved to Canada, for every $1 US, we would get $1.50 Canadian. But in today's market, we now, for every $1 US, get either just above or just below $1 Canadian, depending on the rate of change between Canada and the US. Thanks for watching.